All right, ready to take notes on credit reports and scores. Make sure that you have your note-taking guide open in DocHub and you are ready to take notes. So first of all, starting on page 1, you have 4 definitions to put on there, and I think all 4 of them are on this slide right here. So a credit report, we're going to talk about that. The process of reporting credit and coming up with your credit report starts with the borrower. That is you, the person who is borrowing money with the promise that you're going to return that money to whoever you borrow it from. And that would be the lender. The lender is who you're borrowing the money from, a person or organization who makes those funds available for you to borrow. And the credit history comes from the record of your past loan and credit-related transactions. And so the credit report is the record of a person's use of credit. So how credit reports are created starts with the lender. So for example, a bank is loaning you the money and they are reporting your account history to a CRA. CRA stands for Credit Reporting Agency. So Credit Reporting Agency is keeping a record of your account or credit history, and therefore the credit report is that record that's created by the CRA of an individual, your credit history. And so you can summarize that one for the next blank on kind of that second row. The credit reporting agencies are listed here. That would be your next blank. So there's 3 of them, Equifax, Experian, and TransUnion. Your credit report could vary across the 3 credit reporting agencies, but it's going to be pretty similar because your credit is the same everywhere. It's just that the way that they figure the numerical value of your credit is going to be a little bit different. If your credit has ever been has never been used, you've never borrowed money, you've never done anything to put on your credit report, then you just will not have a credit report. And 3 examples of, So this is not your 3 examples. This is the information that you'll find on a credit report. So we have 4 categories: your personal information, your account information, public record information, and inquiry information. And we'll talk about each of those. So the first part is the personal information, your consumer, your information. So this is information that's provided to lenders when applying for credit. So when you go and you apply for a loan, this information is going to be on there: your name, your current and previous addresses, phone number, at least part of your social security numbers, just so they can kind of verify that they're looking at the right person, date of birth, and employment history. And so your box on the note-taking guide asks for 3 examples. So there's more than 3 right there. And then credit account information is the next part that's on your credit report. This is going to show all the different types of credit you have had: credit cards, loans, and you can see several different examples right here. And this is looks just like the thing at the bottom of the page on page 1. Types of credit, which we'll talk about in a minute: loan amount or the credit limit if it's like a credit card. Date of dates when you opened the loan, when you closed the loan, if that applies. The current balance, so what you currently owe on that credit, and the payment information, what your normal monthly payment is. Moving on to page 2. So types of credit. You will see closed end and open end already listed on your note-taking guide. So we're kind of going across with each of those. Closed end is right here. So it is also known as installment credit, and the definition is that the borrower repays a specified number of equal payments. So when you get a loan, they tell you, okay, you're going to pay $250 a month for 5 years. And so that's a very specific amount, and you're paying a very specific amount per month. That is installment or closed end credit. There is an end on that loan when you will have it paid off. Features that are that your contract outlines your repayment terms, and some examples would be auto loans, education loans for college, and mortgages, which is a home loan. And the other type of credit is open-end credit, also known as revolving credit. This is a line of credit that's established in advance. So maybe they tell you, okay, here's a credit card for $2,000 is your credit limit. So you don't owe anything on it until you start charging money towards that $2,000. Once you have charged $2,000 on your credit card, you have met your limit and you can no longer charge anymore. So there is a limit, but you don't have to use it all. And your monthly payment will be based on how much of that card you have charged on, how much your balance is at that moment in time. Some features are that the borrower chooses how much to pay. So if your credit card tells you, hey, we need you to pay at least $100 this month, that's your minimum payment, you can choose to pay the whole thing off. You can choose to pay $500. And so you do have some choices there, and you could pay less, but you'll probably get some fees if you do that. So that's not a good idea. And the main example here is a credit card. Moving on, we have a sample credit report, and that is pictured on the middle of your second page, Sam's Electronic World. So this is showing you a part of what will appear on your credit report. This is like if you had a charge account with a place called Sam's Electronic World. So it's a store, we're going to assume. And so you can look at a couple of things on here. We've got the address of the store, your particular account number with that store, and the status says that this is an open line of credit. You are able to charge, but it is currently past due 60 days. That's a bad thing. It shows the day that you opened that account, how often they have reported it, date of status, I'm assuming that means like today, and the last reported, also today. Apparently this is old. What type of credit it is, revolving credit, looking back, that means it's open end, so like a credit card. Monthly payment is 0, which is typical for an open end credit. Typically, there's not a predetermined amount that you have to pay per month. Responsibility is on the individual. I assume you could also have, like if it's a corporate credit account or something like that, it could be on a business or something. The credit limit. So when you go to this store, you are able to charge up to $500. Your high balance, meaning the most that you have ever had on your card or your account, has been $550. And then your recent balance as of apparently a month after the date of the status is $84, and you have no recent payment. And then if you see down at the very bottom, the account history, it shows that on September of 2012, you were 30 days past due on your payment. And then in October, you were 60 days past due on the payment. So you are going to fill in some symbols. Whoops. That's not even a real alarm. Going to DocHub, so I have filled them in for you to show you what you need to do, but remember you can go to, this is probably a check mark at first, and you click the little arrow, and you can find all of these symbols right there. You can change the color if you wish, and when you place them, you can shrink them, you can move them, or you can delete them, and then you want to click the arrow, the pointer, to get back to not putting more symbols on there. So it says place the following symbols on each section of Sam's Electronic World account. Square is type of credit. So that is revolving credit. Is it closed end? Is it open end? Or is it installment or revolving credit? That's what we're looking for. The loan amount / credit limit is going to be a smiley face. So right now, this is not a loan. It's a credit limit. So $500. The date the account was opened, right there, February 2009. The account balance is right here, $84. And a dot, which I couldn't find a dot, but I used a circle to indicate payment information. So anywhere that it is referring to payments. And right here, I showed that past due 60 days. Here, it's describing some past due amounts, and here, recent payment. I guess you could also put one right there, but I didn't. Anyway, moving on. Wrong place. There we go. All right, next blank. What types of public record information may be in a credit report? So here are some examples of public record information. So anytime that you have been sent to collections, meaning that you owed money to somebody, either a credit card company or a loan, and you were past due a certain amount, they eventually turn you over to collections. And that's when they start calling you and bugging you because they want you to pay them back. And the longer you wait to take care of those problems, the worse it is going to affect your credit. So you do not want to get to that point, ideally. But if you do get to that point, usually if you will just talk to them, they will work with you and try to solve the problem as painlessly as possible. So collection agencies, anytime that has happened, that will show up on your credit report. So now you're applying for another loan a few years later, they're going to see that that happened already, and it's going to hurt you. It's going to mean that you might not be able to get a loan because they're going to see that, well, back then you didn't pay your loan. So what makes me think that you're going to pay it now? Kind of thing. Bankruptcy, if you've ever filed for bankruptcy, that will be on there for sure. Tax liens, meaning that you did not pay your income taxes or property taxes in full, that will show up there. So all the kind of the bad decisions that you make financially are going to be on your credit report for quite a while. And we'll talk about the exact timeline in a little bit. Also foreclosure, which means that you fail to pay back a loan. So if it's on a car or a house, it means that you stopped paying for a significant amount of time and eventually they foreclose, which means they're going to take it back. You're not going to get it anymore. They will come and physically take your car, and then they will try to sell it to get their money back out of it. But you'll be out. You'll be out of car, and you will now have bad things on your credit report. That was a long explanation. I'm sorry about that. So inquiry information. Whoops. Oh, there we go. That's the one I wanted. Inquiries mean that someone is requesting your credit report. So when you go and apply for a loan, they are going to inquire about your credit report. They're going to want to see the whole thing, and they're going to want to look at everything that's on there to figure out if they want to loan you money or not. So this only happens if you, the consumer, have done something like you've applied for a loan, or you've sought to see your own credit report, or you've maybe filled out an application to rent an apartment. A lot of times they will run your credit in situations like that. Getting insurance, there's a lot of different things. It is potentially a negative thing if you have a lot of inquiries or a lot of recent inquiries on your account. So it means that maybe you are trying to get more credit, more loans than you can afford, or it means that maybe a lot of people have already turned you down, and therefore we're going to assume that since a lot of people have already turned you down, we should probably turn you down too. Typically, there's no impact on your credit report, whether good or bad, um, if it was not initiated by you, like you didn't go out and get a loan, it was like someone else. And so, also checking your own report typically has no impact on your credit. And I think that answers the bottom two on page 2. Types of lenders who report to the CRA, the credit reporting agencies. So all of these are examples of lenders: depository institutions, meaning your bank or credit union, credit card companies, retail stores that offer credit accounts, if you have a Macy's card or a JCPenney card or whoever else, Walmart card, any kind of actual credit card that is with a company that is also a lender, and mortgage and finance companies, so places like banks that only do home loans. So what kind of, when, it says, when do lenders report? No, that's not answering this question, but that's what I wrote on my blank. So that's what you should write too. They report all information, including positive and negative information. Put that there, it's fine. Types of data furnishers who report to CRAs. So that includes landlords. They're going to report whether you paid your rent on time. Cell phone companies, same deal. Utility accounts like your electric bill or electric company, water, sewer, trash, whatever, gas bill, and medical providers. So all of these places are just reporting that you paid your payments in full on time. So if you don't, even once, it will hurt your credit. And when do they report? They report when money is owed to them. So if you don't have any medical bills right now, then they're not reporting on an ongoing basis. They're only going to report when you do have a medical bill due, and they're going to report that you paid it on time or that you didn't pay it on time. And that is actually a good way to build positive credit history, is just to get accounts with these places after you're 18 and start paying payments on time. That's all you got to do. Okay, 5 examples of information not in a credit report. I've given you 6 of them here. So your race and gender, not going to show up there. Religion, nationality, any kind of accounts you have with banks that don't have to do with loans. So if you have a checking account, savings account, that's not on there. Your criminal background, not on there. Your buying habits, they're not seeing what you buy. They're only seeing what organizations you borrow money from. And any kind of medical information other than the place where it says not where. I think it has to show the company though, that you owed this company, this hospital or whatever, and like how much and what day it was due. But it's not really going to go into details about what you had done or anything like that. So remembering always that your present self impacts your future self. Some items are going to remain on your credit card, your credit report for a long time. So here's some examples. Accounts that are in good standing, those will always stay on your credit report. Good. Closed accounts that are in good standing. So you paid off your credit card and you decided to close the account. That's going to stay on there for 10 years. Any late or missed payments are going to stay on there for 7 years. Public record information, that stuff about, not paying your taxes, and what was the other stuff? And Collection agencies, bankruptcy, foreclosure, those things are going to stay on there for 7 to 10 years. And inquiries, meaning people who have pulled your credit to see if it's good or not, that's going to stay on there for 2 years. So the only way to remove negative information from your credit report is time. That's the only thing you can do about it. Unless it is incorrect, you can't do anything about it once it's on there. It's just there. And you got to wait it out, and you got to try to be good from now on and hope that somebody's going to give you a loan when you need one. Your credit score definition here is a numerical summary of your credit history. So they're going to take all those factors that we talked about, and they're going to give it a number so that banks can look at that number and kind of know what your credit worthiness is. How likely are you to repay a loan? That's what they want. They want to know that they're not throwing their money away. They want to know that they're giving it to someone who's going to repay it. And so follow along on these weird blanks, but what information is included in a credit score? And that is right here, number and type of accounts. A credit score reflects a particular point in time. What does a score indicate about a consumer? It indicates your financial reliability. Next. Oh, this one's even worse. Okay, who most commonly produces scores? So there are 2 credit reporting agencies who commonly produce scores. This is different from the credit reporting agencies that we talked about before. That's where you can actually pull your credit report from Experian and TransUnion and Equifax. But the scoring system comes from 2 places, FICO and VantageScore. So then the next blank, what are the score ranges of those 2 systems? And the score ranges are right here. A higher score typically means what? It means that you have a higher chance of credit repayment. So in this case, you want a really high score. Most of the time when you hear people talking about their credit score, they're talking about FICO. And so they're talking usually nothing higher than, low 800s. But anything under 700 really is not good. So you want to stay 700 or above, and 800 or above is really good. And all that does is it tells people that you have a high chance of repaying your credit. So this calculation depends on who you're talking about, FICO or VantageScore. And a consumer typically does have multiple scores. You've got one score from each of these agencies out there. They're coming up with this stuff whether you want them to or not. So it's good to know about it. Last page. In addition to access to credit, what are 2 other ways an individual's credit history may impact them? Oh, I have an example slide. Oh, that's right. So just real quick, FICO score right here. So if you have a 730, that's the highest that's on here. 660 is even lower. 590, that's not good. So you can see that it correlates to the interest rate that you are offered on repaying that loan. And in this case, we want a low interest rate because that means interest is the extra money you're paying on top of the amount of the loan. So if this is a $15,000 loan, let's say this is for an automobile, if you have a higher FICO score, you're getting a lower interest rate. Overall, your payment is going to be lower, and therefore your total amount that you're going to end up paying after the loan is paid off is lower. Okay, so this is how your credit history affects you in other ways besides just getting loans. It affects your insurance rates. The higher the score, the lower you're going to pay in insurance. So car insurance is mostly what we're talking about. Your employment. A lot of employers are going to pull your credit score. They're going to pull your credit history whenever they are thinking of hiring you, and that's just going to tell them if you're a responsible person or not. So it could affect you not getting a job. Public utility services. So again, if you have a good score, they're going to give you great rates and great business and kind of give you more leniency. But if you have a low score, they may require a bigger deposit up front. They may charge you extra every month, just to make sure that they're getting their money's worth out of you, kind of. And then housing. So whenever you fill out a form application to rent an apartment, they will pull your credit. And obviously, whenever you're trying to buy a house. Okay, so 5 strategies to build a positive credit history. I think there's 6 here. Positive credit history means higher credit score. So, first and foremost, pay your bills consistently and on time. Biggest thing right here. And easiest, really. Maintain reasonable amounts of available credit. So, if you get a credit card or a loan, mostly let's talk about a credit card. Don't max it out. Don't spend all the available money that you're able to. About 40% is a good amount to not go over. If you go over that amount, and then you try to apply for a loan, they may not let you get that loan just because you have too much of your available credit. Apply for credit sparingly. So when you need a loan, think about it ahead of time, research some options, and then apply for the one that's really the best situation for you. If you go out and you fill out 5 credit card applications at the same time, that is going to be bad for you. Don't do that. Have a mix of different types of credit accounts. So you could have a credit card and a store credit card and a auto loan. And that's okay to kind of have a mixture. Having only one thing can be a bad thing. And that's the next thing. Do not have too many of one type of account. And then you want to check your credit report annually. You are able to do that for free every year, and I think I'll talk about that later. But you want to do that just to kind of check and see if there's anything that's incorrect on there, and also just to be aware of what is on there. Strategies to build credit. So here are some things that you can do right now to build credit. First of all, a small closed-end loan. So getting a loan for something fairly small. Maybe it's for a vehicle of some sort. Maybe it's for a farm animal. There are loans for that as well. But something fairly small. And then you want to do it from a local bank, especially build some relationships with someone local and set up automatic payments to make sure that you pay those payments on time. It could even be that you have the money, but you get the loan and then just pay for it with the money that you have to build credit. Credit card with a cosigner. So that is going to be someone over 18 who is equally responsible for paying back debt. And that is one of the blanks on your note-taking guide. How is a cosigner impacted? They are equally responsible for paying back debt. So not just everybody is going to cosign for you. They are going to be wary as well if you've never had bills before, so they don't know, are you going to be able to pay this back or not? A secured credit card. So that is like if I had a credit card, it's a special kind of credit card, and I like preload cash onto it. So maybe let's say $500. Now I have a credit card, it's kind of already paid for. It is already paid for, but it functions just like a credit card. And by using it, spending the money, and then even paying it back to keep my $500 on there is going to build my credit. So that's good, but it's a really, really safe way to build credit. And then being an authorized user on a credit card. So say your parents have a credit card and they get an extra credit card, a copy, and make you an authorized user. So you are not legally responsible for the debt. It's just like if you had a debit card connected to your parents' checking account, they're still legally responsible for that account and the money that you spend. But as long as they trust you, then you can build some good credit in that way. And I'm sorry, this is weirdly not, why is that even there? But at the bottom, it says that having no credit history could be just as challenging as having a negative history. If you go to apply for a loan and you have no credit whatsoever, um, they don't have anything to go on there. And so they're kind of just as likely to turn you down. All right. I think we can fill out all the rest of them. Uh, No, the next two are here. So, how often can a free credit report be requested? And that is annually from each of the three credit reporting agencies. So, from Equifax, TransUnion, and Experian, you can get all three for free once a year. It is important to request your report, even if you don't think that you have used any credit, just to see what's on there and make sure that everything looks good. If you are denied credit, if you're turned down for a loan, you can request another free copy within 60 days. And the only government-sponsored free website is annualcreditreport.com, and I believe that's one of your blanks. And so when you are accessing your credit score, you do have to order the three separately. Usually it costs a fee, unless you do it that one time a year. And the three CRAs, Equifax, TransUnion, Experian, are the primary source, but your scores are going to differ between. So you can't necessarily look at all three and compare them. They have their own ranges. So if you do find an error, and it happens, you need to contact that CRA wherever you got the credit report from who has made the error, and you need to provide correct information. Whatever's incorrect, you need to try to take care of it. They have about 30 days at that point to investigate what it is that you say is wrong. And if they do find an error, they're going to provide the correct information to all three CRAs, and you will want to make sure that that happens. Paperwork, things happen. You want to make sure that you check up on that because it could mean that you don't get a loan later. If the dispute is not resolved, so you can add a dispute statement to your report. So maybe it says, that you paid something 30 days late and you're like, no, I never did that. So even after all this, we don't resolve it. You can make a statement that just says, customer says they didn't pay it 30 days late or whatever. And just a warning, there are these things called credit repair agencies, and you'll probably see commercials about them. They're going to offer to fix your negative credit report. But according to the Better Business Bureau and the Federal Trade Commission, first of all, you can probably do just as good of a job at fixing these problems as they do, and they are going to charge a fee. So there's that. And you need to be cautious if anybody is trying to promise you instant help because there's no immediate fix for negative credit. The only thing that they can do is try to correct mistakes and help you to do better in the future. But that's really all you can do. So, all right, bye.